One is when we look at employment or unemployment. There's another really core data you could look at if you want to carry it further, and that's tax receipts. Because the government can fudge the books a little bit on, well, we have this number of people employed or part-time workers or whatever, but they can't fudge tax receipts, money coming into the Treasury. So if you want to carry my work a little bit further, you could look at tax receipts in terms of a measure of, are we increasing jobs or are we decreasing jobs? Probably a good reference for that would be Ed Dunn, a dear friend of mine, Metropolitan, passed away this year, really started that work of tax receipts. Look at that instead. So there's an area. Another question came off the break about China. And a lot of comments about China because it's going to impact our markets now and on into the future. This thing in China is not a flash in the pan. It's going to continue to be our leading economic opponent in the world. And the economy is amazing there. I first went to China 40 years ago. Virtually everybody that I met in China wanted me to bring them home to America. Said, I will work for you for free for 6 years. Just give me a place to live and food. Whatever you want, I will do it. And now when I go to China, people say, well, we'll build you a house. Come and live with us. It's like totally different. I got picked up in a brand new Rolls Royce in Beijing. This time, a brand new Rolls Royce in Shanghai. And there's Starbucks every place. As I said the other night, in 1940, in China, there was a military figure wherever you went. Mao Zedong. There's pictures every place in China. Now, there's also a military picture every place you go. Colonel Saunders. Kentucky Fried Chicken. Every place is Colonel Saunders, Colonel Saunders. Wow, that's really changed in China. And they're economically driven. They love to trade the markets. And they have a huge economy. So, an important lesson, one of the lessons of our United States market is don't fight the Fed. Have anybody heard that? Don't fight the Fed. The Fed is lowering interest rates and increasing money supply. Don't fight it. Well, how about China? They have a Fed. Their central bank is essentially their Fed. And they're in the same position. They're going to try to regulate their economy as much as they can. In fact, they're probably more adroit at it than the American Fed because we have a little popularism to our Federal Reserve. We have a little input to it. But in China, they go, oh, they caught a guy who was writing a bearish news in China a week ago. What did they do? Put him in prison. That's how they'll fight the market. We don't like that guy, arrest him, shoot him. You know? Like, wow, that's totally different, isn't it? They will fight the Fed to that degree. I mean, they become the Fed to that degree. They will fight the market as much as they can. They say it almost every day. So I think a good strategy on China is don't fight the Fed. Don't fight them. They're going to continue with that approach to the marketplace. If you really get involved in China, that's another issue that we do a lot of work with the Chinese market now. And there's American data that forecasts the Chinese market quite well. Right now, September 12th, 2015, the Chinese market's going to rally because of the economic conditions in America. After all, who buys all the junk from China? We do. Not people in Brazil. We do. So we're kind of a symbiotic relationship, and that's an emerging market you should be more than well aware of. Okay, Harry, if you would. Well, what about inflation? Oh my gosh, this is such an important chart. Very simple rule. When inflation is above 5%, look what happens to stock prices. Markets come down. So whenever we start to inflate by more than 5%, you want to get out of stocks. I don't care if it's a year ending in 6 or 9 or 33 or whatever it is. Inflation above 5%, the stocks are overheated and the market will come down. Maybe not tomorrow, but it will come down. Why? Why would stocks come down when inflation is above 5%? Because who controls the game is the Federal Reserve System. They don't want an inflationary environment. They want to see the rent and market experience of 1914. They're going to step in and slam interest rates, decrease money supply. Their job, their mission statement is a moderate economy. So when the economy gets really good, they'll step in, and when it gets really bad, they'll step in. It isn't just inflation by itself, it's because of what inflation causes, the action that causes the Federal Reserve to come in and do something. So again, I'm really big on causation. Inflation by itself, who knows what it means, but it's a sign for the Federal Reserve to go, okay, here we go, guys, let's hop in, and we will take action. That's why it's such a good long-term indicator of stock prices. What this stuff causes the Feds to do. Question?
So this inflation signal supersedes any other cycles that you would be?
Yeah, if inflation gets above 5%, I have real tight stops in or I'm out of the marketplace, because at some point we're going to come crashing down. So I'm a very leery investor with inflation at 5%. When it's low, when inflation is, as long as we're not deflating by more than 2%, stocks is really bullish for stocks. But if you get into a deflation environment, we're deflating more than 2% a year, which is rare, and that's not good for stocks, because if we're deflating, there's no economic growth, there's no earnings, there's no profits, and we got to get out of this recession. Big recession.
You're using the CPI to predict inflation?
You can use the CPI. There's a jillion inflation rates, but the GDP or CPI are both very good. And what's actually going to happen, you'll be reading about in the newspaper, and you'll be complaining, your wife will be complaining to you. Say, oh, I can't believe how much butter costs now. Once you start hearing that, oh yeah, Larry said about inflation. Just go check your inflation charts.
Is that inflation excluding food and energy?
I'm sorry?
Is that excluding food and energy prices?
Inflation, no. I want inflation to include food, energy, everything.
Because the Fed always excludes.
Well, yeah, but I like to look at total inflation costs. But we know, and again, don't read these books. Don't read my books. Go read the reports from the Federal Reserve System. They talk about inflation with or without food and energy costs in it. The Federal Reserve, I mean, this is what we should be reading, but boy, it's hard to read stuff. You know, my books are really short sentences and little words. The Federal Reserve, like, oh, one paragraph with like 17 pages. It's really hard to read that stuff, but it's worth reading. So the best fundamental tools, if you want to Google these and become a little more astute, the Philadelphia Fed's Aurora Diebold Scotty Index, business conditions, is really good. The Philadelphia Fed's Business Outlook Survey is good. The Anxious Index and the Conference Board leading economic indicators and their unemployment numbers those are numbers I look at a lot. That's good fundamental data. It's probably boring to some of you. It doesn't it doesn't impact the market every day. You don't have to look at this every day or every week. I look at it occasionally, probably more often than you do, because that's what I do. But it's nothing you have to look at every 5 minutes. That doesn't change the market. You can look at this, once a month. Then we also have the Conference Board Employment Index. You saw that. The Chicago Fed National Activity Index is a good one, and the ECRI Economic Council Leading Index has also been a good leading indicator of recessions, because recessions cause stock prices to go down. So I'm not the smart guy in the room for sure. I can't predict stock markets by looking at stock prices, but I can by looking at recessions. When all these fundamental indicators get negative and get bad, I better get out of the stock market. That's how we're going to time the long-term trend of stocks. Please. When they don't confirm each other? Yeah. Oh, they do. You get 3 or 4 of these coming together, that's enough. If I see the anxious index above 30, I don't want to be in prices. I mean, almost any of these are so powerful, but if you study them, you'll see they do move together. You may not get 10 out of 10, but you're going to get 7 out of 10. So if I get 3 or 4 out of 10, I'm really careful, because they all reflect the economy in a little different way.
Is it weekly or monthly?
Some of these are reported weekly, some are reported monthly.
When you look at them?
I look at them about every 5 minutes. No, I look at them about twice a month. So the employment ones come out monthly. I want to look at those monthly. There's a leading one of employment comes out every 2 weeks. But generally, I know where the numbers are now. They're not going to shift that much in a week or in a month. So you don't have to focus that much on them. I do because that's what I do. But you people don't have to do it like I do it. PE ratios. I want to put PE ratios into perspective for you. In August of this year, the PE ratio in the Dow was 15.94%. So what does that mean? Mean anything to anybody? How do you use that number, right? We know PE ratios are important, but so what? Well, we can use those PE ratios to give us a sense of valuation of the stock market, what the expected growth of stocks or return will be with stocks, expected returns in the next year or two, with a simple little formula I'd like to share with you today. And that formula is to take the current PE ratio and multiply it by 0.57, subtract that from 20.67, that's the expected 5-year average return, minus 0.57 from the current PE and subtract from 10.46 the annual rate of return. We'll go through the math of it in a moment, but I'll leave that slide up for just a little bit. In other words, if we take the PE ratio, put it through some numbers, compare that versus the average rate of return, we can see if today's PE ratio is high or low, and it'll tell us a valuation measure for stocks. In January 2008, the S&P ratio was 21.76. Doing that math, it gave us an 8.2% valuation, but on average, it should be 10.46%. So we had a much lower expected return by 2.23% than the average. The average has been 10.46%. The PE ratio at this value says the expected return is 8.2%. We're a smaller rate than we would expect, so the market was over in 2008 at the peak. If we look at it today, it's 16.2. So here's the math. We'll walk through the math of this. We're going to take 16.2 times 0.57. That gives us 9.234. We're going to subtract that from that 5-year expectation, and that gives us 11.4. Compare that to the 10.46 number. And we see that actually we're 1.1% better than average. So we're not in ideal area in terms of the PE ratio, but we actually have a higher expectation with this PE ratio than we do on average. I'd like to see this at the 2009 low. The spread was positive by about 3 percentage points, saying, yeah, you really want to buy stocks here. So we can use a PE ratio as a valuation measure, so no longer is this just a number for you, a wandering generality, oh, it's 16.2. What the heck does that mean? Now you know. You can plug that number in the future, whenever, and say, oh, yeah, we expect a better rate of return than the average of 10.4 like now. We expect 11.4. Or if that's 7, then it's really negative because P ratios are way too high in the marketplace.
Larry,
Please.
most of the data so far has been on the Dow. Now we're jumped to the S&P. Does it matter much?
This is a good point. Currently, the S&P earning PE ratio is substantially higher than the Dow PE ratio. But I just follow the Dow because it's a blue chip group. That's my stock, so I'm concerned about the Dow. I do acknowledge the S&P is higher. That's a contradiction in the market. We're always full of contradictions. Yes?
Do the number metrics that you use, the 0.57, apply to the S&P as they do the Dow, or is it going to be a different?
The original research was done by a couple of college professors on the Dow, not the S&P 500. So another reason to use it on the Dow. You could go back and look at the S&P and just do the numbers backwards for the S&P. I've just used it on the Dow. Okay, do you know when to sell? Now? Yield curve, Diebold index, anxiety index, unemployment, inflation.